going over to Tim, ever since Macquarie sort of let go of the management rights, that was about 2008, wasn't it? 2007, 2008. Obviously, as Gary's mentioned, the stock's had a good run. Pull back here, is this worth getting into or worth holding off on?
Yeah, look, it's the sort of stock that we tend not to look at too closely. It's an infrastructure stock, although you may say that a large part of its revenues may be from retailing. And we find that the best opportunities for us tend not to be in that space. It's, when you buy infrastructure, you're looking for consistent, low-risk returns. And we like to think that we can do better than that by finding businesses that have the potential to grow very strongly over time. So this is not something that I've looked at. And with infrastructure, you do need to look pretty closely because often they're structured in a complex way. The debt can be tricky to get your mind around. And there is a certain amount of sort of specialist expertise that goes into valuing these sorts of things properly. One comment that I would make from a position of very limited expertise is, to the extent that a lot of the income is from retailing in the airport, then that's a business that you would feel pretty nervous about, I think, given the extent of competition that structural change is bringing to retailers generally. And where previously the duty-free shops may have had a pretty free run in terms of offering discount buying opportunities, you can now buy perfumes online from a host of different countries for much lower prices than the local retailers can provide them. And so competition may be something to factor into the assessment of Sydney airports, but for us it's not attractive on valuation grounds.
That's a good point to make about the retail at Sydney Airport. Also, do you think there's any threat? I mean, they're starting to rattle the cage again about possibly getting batteries up and running. I see the latest addition to the RBA board, Heather Ridout, was in the paper this morning saying that we need Batteries Creek. Do you think that's going to have a negative effect on Sydney Airports, or is it all just more hullabaloo?
Yeah, look, I don't think that's terribly negative. I think the reason that people are pushing for batteries is that the demand is growing, and over time, I think it's almost inevitable that we will need more airport capacity, and so I don't think it's necessarily a huge threat. It's obviously bad news for a period of time, but it just reflects growing demand, which is not a bad thing.
Well, that's true. Let's go to Philip from Melbourne. Philip, are you there?
Yes, I am.
Fire away.
My question is on Atlas Iron AGO.
Atlas, yep.
Yeah, I bought 10,000 of them at $1.83.
Yeah.
And it's the weak link in my portfolio. I'm not sure what to do, whether I should buy some more or maybe get out now or wait for the price to go back up again.
Tim, fundamentally, how would you rate Atlas Iron as an iron ore producer?
Yeah, fundamentally, it looks to be anyone's guess. It's not a business that we've had cause to look at closely. And I'm just having a look at the analyst forecasts that are out there for Atlas. And in 2014, the range of analyst EPS forecasts goes from 4 cents up to 31 cents. So the analyst community is effectively saying we've got no idea what the earnings for this business will be without knowing a lot about it. I presume that means it's a high-cost producer and its earnings are enormously sensitive to the iron ore price. What that means is that to be an investor in Atlas Iron, you need to have a view on the iron ore price. If you have good reason to think that it will be higher than most other people currently believe, then that's a reason to invest in it. But if you don't have a clear view on the iron ore price, then buying Atlas Iron is putting your money on red or black at the casino.
Yeah, and I think the analysts are divided on the price of iron ore as much as they are divided on the price of Atlas Iron as well. Let's go to an email, and this one comes from Matthew, and Matthew writes, I would like to know your long-term outlook and price target for BRU Energy. I recently read a report from JP Morgan saying that BRU was its favourite small-cap energy stock. Also, does the panel believe SMS Management and Technology represents good value at current prices? Okay, let's start with Tim with BRU. Is this one that you've come across?
Yeah, look, I'll start with SMS Management if I can before we get to BRU. SMS is, if I'm thinking of the right one, it's an IT consultant. Yeah. And there are a number of other similar businesses, Oakton, DWS, that we have had a bit of a look at over time, and some of them we've owned. We're not in any of those businesses at the moment, and what we're hearing is that those businesses in general are finding they're going very tough at the moment. They're finding a lot of cost pressure, and they're having to themselves offshore to low-cost centres to get work done to remain competitive on the contracts that we're bidding for. So we don't feel very positive about that set of businesses. In the case of BRU Energy, it's one of those businesses where it's made losses for a long period of time, and if you look at the broker forecasts, then you just need to wait till 2014 and suddenly it will be making enormous amounts of money. And broker forecasts tend to be optimistically biased at the best of times, and when you see a broker forecast for a business that has been losing money but is going to make money in not next year but the year after, what you find is that those sorts of forecasts in particular tend to be very heavily optimistically biased, and as a year passes that hockey stick forecast tends to step out another year and you never quite catch up with it in some cases. So BRU is the sort of business that we don't look at, and I can't tell you very much other than it is indeed an oil and gas exploration production company. It's not the sort of risk profile that we favour. It's not the sort of business that we can readily value.
All right. Let's go to Alan from the Gold Coast. Alan, you're there.
What do you think about United Overseas Australia? It's a property developer in Malaysia.
Yep.
That is selling on a PE of less than 5. It gave back 8 cents capital return about 12 months ago.
That's about 20%.
I can't understand why the price is so low.
Invest in property overseas, is it fraught with danger or?
Look, it is. I mean, development companies have a certain amount of risk to them, and looking from Australia at a Malaysian property developer, that adds a layer of uncertainty and a layer of risk. As UOS, it's quite an interesting beast. If you've been a shareholder in UOS over 10 years, you've done fantastically well. It's gone from a couple of cents to 40 cents. It looks like 1 or 2 cents on my screen back in 2002, 2003. And its earnings per share have risen pretty well from 2 cents to 9 cents over that time. And there's no broker forecast, but based on that track record, it seems as though there's reasons to think it might do well. The thing that terrifies me about UOS, though, is that its cash flows don't seem to reconcile with its reported profits in any way. And so while it looks cheap on the basis of its accounting performance, I'm wondering where the cash is, and I think you'd want to have a pretty close look at the accounts and understand what's driving that. It may be accounting differences, but I'd need to understand why there's not the cash flow to align with the profits before feeling as though this was a business that really was.
Okay, let's go to Shane from Brisbane. Shane, are you there?
Yeah, how are you, mate?
Well, thanks, mate. How are you?
Very good. Mate, boys, MXL, the tin miner in Tasmania and a bit of a gold thing, I was just wondering how you see that, if anything's good or bad or whatever. And as a second question, I didn't tell the girls, what about Northern Star Resources?
Lex?
Look, I don't have particular insight into tin, but MLX is another one of those businesses which has the hockey stick forecast. It hasn't really made money to date, but there's an expectation that it may make money in future. I can't say whether that is a reasonable expectation or not. It's not the sort of business that we look too closely at. Northern Star is a slightly different kettle of fish. It's a gold producer that has started to make money and is expected to do significantly better down the track. And it's a gold producer that has actually generated some pretty reasonable ROE numbers in recent years, although that's off a very low base of shareholders' funds. And that is, that's a good thing for a gold producer. One of the really surprising things about the gold sector, as we've looked at it recently, is that even with the gold price at historical highs, you've got companies like Newcrest that are producing single-digit ROEs, and it seems to be an industry where there's a very strong survival instinct, and when the gold price is strong, these companies find ways of spending perhaps more than they should on exploration, spending more than they should on acquisitions, mining lower grade ores so that they've still got the good stuff to mine when the gold price is not so favourable. And there seem to be a lot of ways that the benefits of a high gold price can be prevented from finding their way to shareholders. So it's an industry that we're a little bit wary of. Northern Star, it looks to be it looks to be headed in the right direction, but you'd want to have a reasonable amount of confidence that the production growth that's being forecast is reasonable, and its gold deposits are located in WA, so there's not a lot of country risk there. There may be good reason to expect that it will achieve continued success. In which case it may be reasonable value, but it's not one for us.
Speaking of which, our first question after the break is via email, and Graham writes, I'm fairly new to the game and had jumped in a bit early on Oz Minerals. Based on recent announcements, I bought it at $7.50. Do you think I should hold or sell? What do you see the outlook for Oz at this point in time?
Yeah, Mark, I'm sorry to say both for you and for the viewer, but from a fundamental point of view, this doesn't look to be a very good business. It's another one of those miners with a very patchy track record. Earnings have been going down in recent years, and the forecast is for single-digit ROE for a few years to come. From our point of view, it'd be very hard to place a valuation on this one that's above $4. So with the share price at $6.85, we're very much in line with the sell recommendation.